In Forex trading, success doesn't come from random decisions. It comes from preparation and structure. And one of the smartest ways to stay ahead of the market is by building a weekly trading plan using the economic calendar. The economic calendar is every trader's roadmap. It lists all the major data releases, central bank meetings, and high-impact news events that can move currency prices. If you know what's coming, you can plan your trades instead of reacting to surprises. Let's walk through how to build your weekly trading plan step by step. Step 1. Start every weekend with a calendar review. Before the week begins, open a reliable economic calendar and scan the upcoming events. Mark the high-impact ones, like interest rate decisions, CPI data, employment reports, or GDP releases. These are the events that can create strong volatility and shape the direction of major pairs like EUR, USD, GBP, USD, and USD JPY. By knowing these in advance, you already have an edge, because most traders lose money reacting emotionally to events they didn't plan for. Step 2. Identify which currencies are in focus. Every week, some currencies take the spotlight. For example, if the U.S. Federal Reserve is releasing rate data, the dollar pairs will be most active. If the European Central Bank or Bank of England has announcements, expect volatility in the euro or pound. Narrowing your focus to the currencies connected to those events helps you avoid unnecessary noise. Step 3. Build scenarios. Don't just mark events, prepare for outcomes. Ask yourself, what happens if the data comes out stronger than expected? What if it's weaker? This helps you plan both bullish and bearish scenarios. When the event happens, you won't panic. You'll simply execute your plan. Step 4. Align with technical levels. Once you know which events matter, switch to your charts. Mark key support and resistance zones, trend lines, and moving averages. If a high-impact event is approaching near a major level, that's a potential trading setup. Fundamentals create the move, but technicals help you time your entry. Step 5. Define your risk and trade timing. Not every event needs a trade. Sometimes the best move is to wait for the reaction after the news. Set clear stop-loss and take-profit levels, and never over-leverage before volatile events like NFP or central bank meetings. Protect your capital, because in Forex, discipline equals survival. Step 6. Review and adjust midweek. As new data comes in, conditions can change. Revisit your plan midweek and make adjustments. For example, if inflation data shifts market expectations for the next rate decision, you might realign your trades accordingly. And finally, Step 7. Reflect at the end of the week. After markets close, review what worked and what didn't. Did you respect your plan? Did you overtrade around news? This reflection helps you improve your decision-making week after week. Here's the golden rule. Traders who plan around the economic calendar don't just trade the market. They trade with the market. They anticipate volatility, position wisely, and let the news work in their favor instead of against them. So before your next trading week begins, take 20 minutes to study the calendar. Mark your events, map your levels, and walk into Monday with confidence, not confusion. Because in Forex, preparation isn't just a habit, it's your strategy.